Hi, Greg Dorsey here at Leeb.com, Leeb.com. It's Tuesday, November 16th. Stocks sold off sharply today, continuing a trend that began 8 sessions ago. The reasons behind the downdraft were renewed concerns about Europe's debt woes and the impact that China's efforts to curb inflation will have on global trade. In Europe, Ireland is facing pressure from the rest of the EU to accept aid from the European Central Bank for a state bailout, even though it's the country's banks and not the government, at least for now, that are at risk. This is raising questions about the health of other nations in the EU's periphery, such as Portugal. We're also learning that Austria is balking at making its portion of the latest payment for Greece's bailout, at least until the country can show that it's making some headway in curbing its spending. Now, this news together threatens to scuttle the EU's bailout efforts altogether, and it puts additional pressures on the euro, which was already in the midst of a significant correction. On the other side of the globe, in Beijing, the government is eager to bring mounting inflation under control. One tool at its disposal is to raise interest rates. But China's central bank is also discussing imposing price controls to rein in soaring food costs, something they did in 2008. Most likely, China will also allow the yuan to appreciate at an accelerated pace as a way of slowing down domestic inflation. Whatever the method they choose, we don't think China will let things get too far in terms of inflation. They certainly don't want a repeat of 2008 with the U.S. and European economies plunging back into recession and causing, because of soaring commodities. That would put a significant dent in Chinese exports, and it would cause unemployment there to rise. By throttling back on their economy somewhat, China can reduce demand for industrial commodities, which, if not cause prices to slump, at least will cause a slowdown in the ascent of prices. In the near term here in the U.S., the S&P is likely to fall a bit further, but we don't see a major sell-off developing at this time. The economic backdrop here in the U.S. remains mixed. We can point to both good and bad economic data coming in, but corporate earnings have been, on balance, fairly strong in the third quarter, as has been the forward guidance, with more than 80% of the S&P 500 companies reporting so far in the third quarter. The average year-over-year gain in profits was more than 30%, and they've topped expectations by more than 6%. Another positive for stocks here, which should help to at least keep a floor under prices, is the much talked about quantitative easing by the Federal Reserve. And finally, we're coming into a period of seasonal strength. Altogether, the correction should prove to be rather shallow, but we'll be watching it and seeing how things develop. And of course, we'll keep you abreast of it. Thanks for stopping by, and we'll see you again soon.